Let's talk about current trends and current trends that you're seeing. Anything from asset values to day rates to difference in routes, utilization. Cal, I'll start with you. You also told me that you always have a view, but you're wrong a lot. So let's start with your current view of what you're seeing.
Well, I mean, we've all been, from at least the owner's perspective, experienced an extremely volatile 2 years. As I mentioned, we started the pandemic with a spot prompt fleet, which was a bit of a headache for a couple of months. But then it quickly turned around, and we started seeing historical high rates for all our assets, and that went through, I would say, the beginning of this year. And then as the war in Ukraine started, some macro lack of visibility, some crosswinds started taking shape. The market definitely started cooling down. But right now, we're really bystanders because most of our fleet is either sold, that we've sold a large chunk of our fleet at the beginning of the year, or the rest has got significant coverage. But there's a couple of, what we see is there's a bunch of good guys and there's a bunch of bad guys. The bad guys are the significant order book that's coming online. The bad guys are potentially lower trade growth. And the good guy, in some ways, is the environmental situation. Our perspective is that we basically now have a modern fleet. We got rid of most of the older tonnage that would be vulnerable, let's say, to these new environmental changes. But one of the main things that we see as a possible cure initially will be slow steaming, reducing the speeds of the vessels, which are now starting to, because of the congestion situation, they've actually increased in speed. So we see that as one of the good guys. We don't know which guy is going to be, if the two bad guys are going to outperform the good guy, but that's our view for the time being. We're not going to be in an expansion mode at the time being. We're also not going to be in a sales mode in the time being. Market dynamics are not positive right now. If you read any of the latest reports, the container shipping sector is in decline. It's hitting bottom, very negative press. So it's just a matter from our perspective to wait and see. And as I mentioned at the beginning, the key for us, what we've seen in history, is that debt is really the leverage that you put in these companies is what can really hurt you. And so we've always operated at a very low debt level, and we continue to do so today. And particularly today, now that we have long-term asset cover, charter cover, it gives us a lot of flexibility.
The panel before, the congestion panel, they talked about supply and demand. It's all about supply side. That's absolutely true in our business. Because again, demand is very projectable over a historical period of time. It is a multiple of GDP growth, it's a multiple of trade growth, it's very straightforward. What's really different is that because of the fact that the value of what's in the cargo, in the box, is so much higher than even the historical freight rates that we've seen, we as the operators have no ability to enhance or impact what quantity would be. So for all intents and purposes, demand is straight up. And so it just comes down to whether supply is plentiful, in which case rates go down to near zero levels in different trade lanes or different markets, or if they're very high. Or if supply is short, then they go to as high as what cargo owners are willing to pay. Meaning, like, it's not about it's not about our ask. It's literally a bid process where if you're desperate, your there's no goods on the shelves, your market share is dwindling as a retailer, then it's a question of how much you want to pay in order to continue to have business. And that's what we've seen, is that bid up was not just extremely high and very aggressive across the board, especially for the US, but really occurred over a long period of time. This current period is a little bit different in that the expectations of cargo availability is very high, meaning like there's plenty of cargo available because you've had systemic shifts away from the West Coast. So what's happened on the spot market to California, to Seattle, all those different markets has fallen tremendously because beneficial cargo owners have de-risked themselves from West Coast exposure because everyone didn't want to be stuck in a strike situation. You already had a pandemic-induced congestive situation. Why would you want to also be in a scenario where the labor union struck and then you wouldn't be able to move any cargo? So that had happened systematically over the first half, and that's why you have huge congestion on the East Coast where the rates have come off a little bit, but not to the extent that the West Coast has, because quite simply the flow has shifted. And so that's hopefully a little bit about how the market dynamics are happening right now. and happy to elaborate further.
And Doctor, take us through your perspective in terms of what you're seeing in current trends.
I think Char was right in describing the market as having a couple of bad actors and a couple of good actors. I think we are in a very interesting period in container shipping in particular, where high order book and potentially high scrapping because of the regulations could tilt the market either way 2 or 3 years down the line. Demand is another uncertainty given the geopolitical and other macroeconomic developments, the high energy prices, interest rates, the war, and the like. So we need to navigate through, I wouldn't say uncharted waters, but interesting and pretty wavy waters. One would need to think to focus on a sub-segment level to try to sort out a bit, at least the supply side. I think looking at the smaller vessels versus the larger container ships, for example, on the smaller container ships, there is on average about, I think, 20% order book, I have the numbers here, and 24% percentage of ships above 20 years of age. As the environmental regulations kick in, the smaller, which might result in some of the older ships not being able to trade post-2025, then a different supply balance might emerge for the feeders and smaller container ships than for the larger container ships. So all in all, it's going to be an interesting situation. Then we might see segment differences developing in the container ship sector. And of course, all of us would have to deal with the macro picture and the demand that we're going to have to serve.
Let's stay with you and talk about how you manage your way in and through this next cycle.
One fortunate thing that the recent rise in rates allow us to do is to be able to secure high rates for our fleet. I think obviously you have the one option is to sell your ship, another option is to secure a long-term charter rate at relatively high rates. So we have for 2022, I mean it's almost the end of the year anyway, all our vessels are chartered. For 2023, almost 80% of our capacity is chartered, so we're also somewhat immune to what happens in the charter market in the near term. And even for 2024, taking into account deliveries of our new building program, more than 50%, 55+% of our fleet is chartered out. So we have transformed market risk, if you want, to credit risk, because we depend on getting paid on those charters. The comforting factor there is that the people we're doing business with have made and are making more money than us over the last 3 years. All the liner companies, I'm sure you can attest to that, are making a ton of money. So we believe, with things being normal, we would have no issue in getting paid from the charterers that we're doing business with. So in a sense, our focus is how to exploit the next 2 years, identifying potential interesting deals, and also, as we already have done, sefer the company into the next decade of its life by developing a new building program and getting delivered of it. I want to make a quick point there. Compared to second-hand prices, new building prices moved up, obviously, but much less so. So the cost basis of the new building ships, when they delivered, would be much lower than what would have been if someone bought a second-hand ship the last 2 years.
Thank you. And Cal, you gave us some brief perspectives on how you're managing your way through the next cycle. Why don't you give us a little more detail in terms of your thoughts?
Sure, Jim. From our perspective now, the key thing is operations. One of the parts that's been negative that we haven't talked about is operating costs, crew, spare parts, time and dry docks. All those costs have gone astronomically high. And with a high charter market, you can afford, to pay more for that. But that is something that we're trying to rein in and control a lot more. And a lot of it is out of our hands, but it's something that we're all, as ship owners and operators, are facing. I think crew demand will continue to increase, and that's going to be something that we need to really pay attention to. The other part that although we're not, let's say, involved in it right now, we're trying to visualize how it will work. The charter market in our segment categories largely disappeared. Either MSC has bought all the ships or all the ships are on long-term charter. So there's, where we used to have 100 ships available in the springtime for when the liners came in to relet, now there's going to be just a very few of them. And in our business, most of the charters and even sales are done on a last done basis. And when there isn't a last done, or there's one vessel that was fixed in the last 6 months, it's going to be interesting to see how that works out. The other part that I think we're all focusing on is the environmental requirements that will start taking place next year, and we'll start grinding it through, as Tasso said, into 25, where unless you are a D or above, you're going to have issues with getting the ability to sail the ship. So those are things that we're all looking at. Now, most of our fleet now it's what we call an eco fleet. They're all smaller engines. They're all pretty much in good position to go through 2030. But we still have a couple of older vessels that we need to figure out and see what the best solution for those are.
Thank you. And Randy, why don't you give us your perspectives in terms of how you manage through this cycle coming up?
Yeah, I think that the way we look at down markets is it's a matter of exposure. We've had the unpleasant experience of going into a number of different markets that we don't have presence in now. At one point we were in Northern Europe, meaning Asia to Northern Europe, Asia to the Black Sea, Asia to Brazil. Anytime as a container operator you pull out of a market, it's extremely painful because you've already collected the revenue up front, and anything that has been left behind, if you will, after the last ship sailing is there, for example, all the container equipment, it takes a tremendously long period of time to get back. And so what we learned through that is you cannot just have a small slice into a market. You need to have scale in whatever market you're in. So that way, when the market corrects, you can pare back the overall exposure. So we've grown tremendously in the Trans-Pacific. We have no illusions over the fact that currently, we may be selling over 20,000 TEUs a week into this market, but we may have to take a step back and look at perhaps a 10%, 15%, 20% reduction, depending on how severe a corrective environment may or may not be. So that's part of it. A lot's been made about contracts, about the fact that similar to charter coverage, container operators have been able to get longer durated contracts from BCOs. There's some of that, but I do want to sanity check some of that because there is a healthy NVO, non-vessel operating common carrier market that does marginalize your ability to actually collect on the BCO contracts. Namely, the BCOs will come back and renegotiate even if they have a 2 to 3 year contract and say, hey, I'm still going to move cargo with this NVO at the expense of our BCO obligations or contractual obligations. So that needs to be managed in, again, your own exposure, an operator's exposure to the market, their comfort level with being able to collect, so forth. The way it connects to the charter market, I do think that a very good point was raised, which is there aren't a lot of spot charter vessels left because of the coverage that's been secured over the last couple of years. So in my opinion, that means there's going to be a bifurcation in operators. There are going to be operators who are not reliant on the spot market, like MSC, who've gone out and bought secondhand vessels because they don't need to consider 3-year charters as a significant part of their fleet, and won't have the type of pressures of having to pay for very, very high charter rates during this next period of time if there is a corrective operating environment, meaning like if the markets are not able to keep up with producing the kind of earnings that their charter hires require, then there is going to be an erosion of credit quality because there have been a lot of new entrants, right? Not just smaller shipping companies, but you have large BCOs that have actually committed, maybe through other shipping companies, Costco chartering ships through a ship operator, and who's actually going to be left holding the bag in that type of situation? Meaning like who's going to actually cover that charter risk, I think is an interesting dynamic because, again, if you have scale, you have several hundred ships that you're operating, your ability to withstand that type of dynamic is fundamentally different than if you're only operating 4 that are all operationally leveraged and the market has changed significantly. So I think those are pockets of again, that's not the overwhelming part of the market. Don't get me wrong. I don't want to be it's not that everything's going in that way, But there is going to be a tiering effect for operators from where I sit.
Let's move from chartering risk to credit risk. So Cal, I'll start with you. How do you think about credit risk with your counterparties?
Well, there's nothing we can do now because we're stuck with whatever we have. So, we just pray that they perform well and they don't waste all the money they're making. I think that in our sizes, we're very limited. We can only operate with the largest companies because, as I mentioned, our ships are 8,000, 10,000 TEUs. So that takes away the smaller and even the new entrants that were really operating. They couldn't handle something of that size. So to Randy's point, I think there is going to be danger. We're already starting to see some of these new entrants having issues with charter payments. But from our perspective, we have the top 4 liner companies as our counterparts, and we're keeping an eye on them and making sure that we operate efficiently, that we behave ourselves, and make sure that they behave themselves when the time comes.
And Tassos, I'll ask you the same question. How do you think about credit risk with your counterparties?
I think I sort of answered it before. It's the same way. I think you try to work with parties that you feel very comfortable with, and we have been lucky in fixing our ships to work with the top-tier companies in the market. And that is the most comforting aspect of dealing with the credit risk situation.
And quickly, I'll change topics to talk about the valuation of your stock, how you think about what your business is worth and how the market values your business, that sort of mismatch between your enterprise value and...
I think a problem of being public is that market has an opinion about how much you are worth, and certain times you tend to disagree with it. I believe, we said it in every presentation we make that we are way undervalued. I can make a very quick calculation because we are well chartered over the next 2.5 years. If I take only the charters that we have and assign 0 revenues to the unchartered days over the next 2.5 years, we get over the next 2.5 years, from July 1st to the end of 24, $22.50 per share, counting all the costs. So this is what we trade about now. We have, in addition to that, over the next 2.5 years, we have 5,500 open days. If I charter those days at a quarter of what the market is today, that would translate to another $80 million. That would be another more than $10 per share. So there you are already to 33. And then there is some still value left at the end of the 2.5 years. So using scrap prices and at 400, not 575 that are now, that's another $10. So, you can easily break down the value and see, where the tangible value is, scrap price, contracts, and an assumption about the future rates, very modest. And we're trading at 50% of that. So hopefully we'll be able to communicate to the market to recognize it.
And let's go to a final topic because our time is limited now. Randy, talk about the regulatory and environmental issues and how you think they'll impact the industry over the next few years.
So earlier, Cal referenced some of the regulatory changes that are coming up next year, and that basically is the rules that kick in due to carbon intensity index regulations. What I look at as, from our perspective, we always have to be compliant with what the IMO passes. The question is whether or not that regulatory regime is drafted in a way that achieves what it's trying to do, right? So even though the carbon intensity index, I think, has very noble objectives, the reality is how it's monitored, how it's calculated, whether it's done on an actual sailing basis, and for us, really on a per cargo unit basis, really per TEU mile basis, is an important factor. So that's why I do think that if you look at the kind of earnings that operators have been able to generate over the last couple of years, and you look at the order book, it actually is not commensurate. What I mean by that is, traditionally, if you looked at how much operators made in the past during boom cycles, and then how much they ordered, it would be vastly higher now than it actually is. And that's because of stranded asset risk, because we still have the opportunity for these near-term regulatory measures to perhaps be amended. And we haven't even dealt with the possibility of a carbon levy, which is really the big factor that all of us are concerned with, whether you're a container operator or a bulk carrier, dry or wet bulk carrier, because that's what, to be honest, society is looking for us to respond to. So we need to maintain some level of flexibility because you can't be investing in the type of assets that are usually durated up to 15, 20 years, but may only be economically viable for 10 years. And that's what's going to kind of dictate the new build future. But there needs to be a better dialogue really between the public and private sector to make sure that the regulatory environment offers a level playing field to both operators as well as owners alike.
Thank you very much. Gentlemen, thank you for being with us
Thank
this
you.
morning.
Thank you, Jim.
And for the audience, thank you.
Thank you.
Thank you.